Problem 10-32, plant asset comprehensive problem. We're going to purchase, dispose of, and depreciate plant assets. So Grace Carroll Associates surveys American eating habits. The company's accounts include land, buildings, office equipment, and communication equipment, with a separate accumulated depreciation account for each of the assets. During the year, they completed the following transactions. So here's our transactions. On January 1st, our first transaction, we purchased office equipment for $112,000, paid $74,000 cash, and financed the remaining with a note payable. So we know we now have office equipment. That's a plant asset. It's going up, so we are going to debit that, $112,000. And we know we paid cash, $74,000. And finance the remaining with a note payable. So to calculate the amount to make this transaction balance, we're going to get $112,000. We're going to subtract $74,000, and that gives us $38,000 of a note payable. To record purchase of office equipment with cash and a note payable. That will be our explanation. All right, April 1st, we acquired land and communication equipment in a lump sum purchase. Total cost was $340,000 paid in cash. An independent appraisal valued the land at $267,750 and the communication equipment at $89,250. Record a single compound journal entry. All right, so let's close this box now because I don't see anything extra in this box that we don't, any extra information that we don't have right here. All right, so what we have now is we've acquired land. We've acquired communication equipment. And we paid in cash. Now, what some of you may be tempted to do, well, we know cash is $340,000, so we can plug that in. Now, some of you might be tempted to take the appraised value and put that in here, $267,750, and then the communication equipment at $89,250. But double check your debits and credits. Do they equal? No, they do not equal. They do not balance. So we cannot use these amounts. So if you remember, this is a lump sum transaction. So this basket purchase, same as a lump sum transaction, we need to figure out the appropriate value of the land and the communication equipment. So our first task is to figure out the market value, total market value of the land. So here's the land, market value $267,750. Here's the communication equipment, $89,250. Remember, these are appraised values. And the total is $357,000, which does not equal this $340,000. That's why we need to, or that's why we couldn't record the transaction that way. So what we have to do is we have to figure out, well, of this $357,000, what percentage of that is the land? And then when we figure out what percentage that is, we will multiply that percentage by the $340,000 and allocate it to the land. So here's how we calculate the percentage value of the land and the communication equipment. We're going to take the appraised value of the land, $267,750, and then divide by this $357,000. And that gives us 75%. Then we do the same with the communication equipment. $89,250 divided by $357 gives us 25%. So these two percentages, 75% and 25%, must equal 100% exactly. All right. And then we're going to take these percentages and we're going to multiply them by this cash percentage down here, 340,000. So 75% of 340,000 is 255,000. So that means the land's value on our books is going to be 255,000, and the communications equipment value on our books will be 85,000. So 225 at 85. 225 and 85. So always double check now. Do our debits equal our credits? And they do. To record purchase of land and communication equipment with cash. Oops. It's supposed to be 255,000. I did not double check that my debits equal my credits. Naughty. All right. Now, on September 1st, we sold a building that cost us $540,000. Accumulated depreciation of $240,000 was as of December 31st of the preceding year. Carol received $380,000 cash. Depreciation is computed on a straight line basis. The building has a 40-year useful life and a residual value of $60,000. So we are disposing of a plant asset, which happens to be a building. Now remember, when we are disposing of a plant asset, there are 4 steps right here. And the first one that we always have to do very first is bring depreciation up to date. So let's double check to see if depreciation is up to date as of September 1. So this accumulated depreciation is through December 31st of the preceding year. So we have to update depreciation from January 1st to September 1. So the first thing I recommend you do on a piece of scratch paper, and I've done this in Excel, is enter in or do T accounts for our building and put 540,000 in there and make a T account for its associated buddy account, accumulated depreciation. Remember, their buddies are always together for the life of the equipment, or excuse me, life of the asset, which in this case is the building, and put in $240,000 in there. So here's my 2 T accounts. I just happen to do it in Excel. It's easier. So I've got building, 540,000 is what we originally paid for it. And I put that on the debit side because that's the normal balance for an asset. And accumulated depreciation has a normal balance on the opposite side since it's a contra asset. And this $240,000 is the, let me double check, yep, accumulated depreciation, but this is actually technically not up to date. All right, so it's not up to date. So we have to update the depreciation from January 1st of this year to September 1. So how many months is that? Remember, we're not going to count September because this is the 1st of September. So we're basically going to count depreciation from January through the month before September, which is August, and August is the 8th month. So we need to record 8 months of depreciation. Again, why do we have to update it? Because this says the accumulated depreciation is only through December 31st of the preceding year. Okay, so here's how we're going to do depreciation. Notice it says this company uses straight line for the building, and it has 40-year useful life, residual value of $60,000, and we said we're going to do it for 8 months. So here's my calculation. First of all, we need the formula in words. Costs minus residual value divided by useful life times the number of months divided by 12 months. So the cost was $540,000. Residual value of $60,000. And we're going to divide that by 40 years. And it's 8 months from January 1st through the end of August. So we do the math, and that's $8,000 of depreciation for this partial year for 8 months. So we have to record depreciation of $8,000. So we have depreciation expense on the building. It's an expense, so it's increasing, so that's why it's being debited. Accumulated depreciation in the building is being increased by $8,000. That's a contra asset. So let me update my T account. So we've got $8,000. And now we've got a balance of $248,000. To record depreciation on the building. All right. So let's get back to our 4 steps of recording the disposal of a plant asset. We've done step 1. We brought depreciation up to date. Now we can do these other ones in any order we want. So let's remove the old disposed of asset and the associated accumulated depreciation from the books. So going back to our T accounts, since we're getting rid of this building and its accumulated depreciation. Remember, if we get rid of the building, we have to get rid of the accumulated depreciation. They are buddy accounts. They're together forever. So let's start with accumulated depreciation since it's going to be debited. How do we get rid of this accumulated depreciation? We got $248,000 balance on the credit side. Therefore, we must debit it $248,000. That's accumulated depreciation on the building. Now, we also received some cash. To find out how much cash we got, let's go back here to the description. Sold a building that cost $540,000. Yeah. We received $380,000 cash from the sale. $380,000 cash. Okay, I'm going to skip a row because this is going to be our gain or our loss. And now I need to go back to our T accounts, and we now need to get rid of the building's asset account. So how do I get rid of an asset account that has a $540,000 debit balance? Well, I need to credit it, $540,000. So the building is going away, $540,000. Okay. Now we need to figure out what is going to make this a transaction balance. So we got $540,000 on the right side. So how much do we have on the left side? $248,000 plus $380,000 gives us $628,000 on this side, the left side, and $540,000 on the right side. So now I need to subtract $540,000 to see what the balancing amount is. So that gives us an $88,000 that we need to put on the credit side. Now there's 2 ways we can figure out if this is a gain or a loss. We know that this is a gain because this is on the credit side. Credits, if it's on the credit side, that's like a revenue. Gains are treated like a revenue. So it's a gain on disposal. The other way to figure out if that's a gain or loss is let's figure out what we gave up. So back in Excel, what we gave up. So what did we give up? We gave up the building minus the accumulated depreciation. That's its book value. So we gave up $292,000 of an asset. Again, this is the book value of the building. What we received. What did we receive? We received cash of $380,000. So what's the difference? Well, our simple Excel formula is this minus that. That gives us our $88,000 gain. How do I know it's a gain? Because we received more than what we gave up. To record sale of building. Okay. Now we're in the home stretch. We're going to record depreciation on the communication equipment. Communication equipment is depreciated on the straight line method over 5 years with a 0 residual. So let's see when we bought the communication equipment. Let's scroll back up here. Communication equipment was purchased on April 1st. So we have to calculate straight line depreciation from April 1st through the end of the year, because that's when we use this during the year. We only used it April, May, June, July, August, etc. So here's how we're going to calculate that. Remember, it said we're using straight line depreciation. So we need to know the formula in words. The formula in words is cost minus residual value divided by the useful life times the number of months used during the year divided by 12. Well, the cost is $85,000. It said the residual value was 0. And if you want to see that information at the same time, you can bring it up over here. Straight line method over 5 years with a 0 residual value. And how many months did we use it? Well, we use it April through December. So in other words, we did not use it January, February, or March. So we did not use it for 3 months. Therefore, we used it for 9 months. Or you can just count. April through December is 9 months. So once we do the math, we get $12,750 of depreciation for the partial year from April through December 31st. And that is depreciation for the communication equipment. So we got depreciation expense, communication equipment, accumulated depreciation on the communication equipment, and to record depreciation on the communication equipment. All right, so our debit we said was $12,750. And the last thing we need to do is we need to record depreciation on the office equipment. Office equipment is depreciated using the double declining balance method over 5 years with a $2,000 residual value. Now we need to figure out, well, when did we purchase this office equipment? We purchased it January 1, so we're going to record a full year of depreciation. And the depreciation method we're using is double declining balance. So we need to remember what the formula is in words. And that is cost minus accumulated depreciation times 2 times 1 divided by useful life. And it says the useful life is 5 years. So the cost, according to my instructions, are $112,000. I want to show you where we got that from. So I get the cost of the office equipment from up here, $112,000 that we got on January 1st. And it's 5 years for the useful life. Now notice some of you are going to try to use the $2,000 residual value. Remember, double declining balance does not use the $2,000 residual value until the very last year of the depreciation schedule. This is not the very last year. So this is just extra information that we're not going to use. So we're going to do cost minus accumulated depreciation And since we're calculating depreciation for its first year in use, there is no accumulated depreciation. That's why we use 0. Times 2 times 1 divided by 5 years gives us $44,800 of depreciation. Copy, paste. It gives us depreciation expense on the office equipment, and then we've got accumulated depreciation on the office equipment. To record depreciation on the office equipment. And that's it.